And we'll now begin with our panel discussion. Andrew, let's start with you. Why did you, Jay, and Bart, your co-founders, found BLab? What exactly is BLab? What are B Corps, and how is a certified B Corp different from a benefit corporation?
Thanks, Laurie. Hopefully I can remember all those questions. You might have to remind me. BLab was started 15 years ago. We're the nonprofit organization behind the B Corp movement. And it was originally started by three of us who actually went to college together at Stanford a long time ago at this point. And we had all gone off and done different things in the private sector. So Bart and Jay built a footwear and apparel company into about a $250 million business with venture funding that they sold in 2005. And I had spent my whole career in the private equity industry and lived through sort of the arc of that industry in the 90s, going from being really about investing and scaling businesses to being about how fast you could, how much leverage you could put on a company, how quickly you could spin it back out or spin its pieces back out in order to maximize returns quickly. Which was a pretty soul-sucking arc, I would say, for that industry. And so the three of us were all at a point where we had sort of seen, on one hand, the power of the private sector to attract capital and talent, and therefore to scale. And on the other hand, the power of the private sector to, with an ethos that was all about making money and externalizing as many costs as possible onto society, seeing how much damage that could do as well. And so we were interested in trying to figure out if there was like a different way to use capitalism. A lot of people now would call that like stakeholder capitalism or inclusive capitalism. But at the time, like the kernel of the idea was we need to change the economic system so that business is being used as a force for good. And so we started by recognizing lots of people had been out there doing work like that for a long time, socially responsible investing or responsible business practices. But what felt like it was missing was sort of like the market infrastructure that would help people really understand like what's a good business and how can we be one. And so we created this certification called a B Corp. When we started, there were 23 companies in the summer of 2007, mostly small private companies led by really inspiring entrepreneurs who were like, we're in, without really knowing what they were in for, but who were totally committed to the idea. And today, there are about a little over 4,000 certified B corporations. What started as a movement of some small companies in the US is today a movement that's in 77 countries around the world. And those companies range from small private companies to companies that are growing fast with lots of venture or private equity capital to now, in the last 18 months or so, over 20 companies that are in the public markets that have gone either through IPOs or public companies that have become B Corps while already in the public markets. And so it's become a global movement. And along the way, we've realized that there are some fundamental structural problems with the economy that need to be addressed if we want business to be used in a different way. And I think one of the most important things that we realized early on was that while we wanted to have a certification that could measure the social and environmental impact that a company was having, the impact that it had on its workers and its communities and the environment, we also wanted to know that those businesses were built for the long term, that they had social impact built into their DNA. And we realized that required us to actually change the fiduciary duty of the board of a business. Like, it's one thing for a company to say, yeah, when things are good, we're going to consider our other stakeholders. It's a different thing for them to make themselves legally accountable to do that. And we thought at the time that would be as easy as going to the shareholders and taking a vote and amending the company's corporate articles to say we're gonna be responsible to our stakeholders. It turned out you couldn't actually do that. That if a company had done that and sent their new articles into the Delaware Secretary of State, which is where 2/3 of large corporations have their home, that they would have gotten a rejected stamp. And so that led us actually to pass statutes in 44 states around the US and now 7 other countries that actually create an alternative corporate form called a benefit corporation. So the benefit corp that you asked about is a legal form, just like a C corp, except for a company is opting into some additional fiduciary responsibilities to consider a broader range of stakeholders to balance the interest of stakeholders with the interest of shareholders. And today, over 10,000 companies have adopted that new legal form of incorporation, including lots of companies now in the public markets. So that's been like a really, I think, critical shift in people's thinking, is like recognizing if we want to have stakeholder capitalism, then we need stakeholder governance.
Thank you, Andrew. Fantastic. By the way, I'm muting myself when I'm not speaking. We have a major thunderstorm that's descended on us here in the Berkshires. I kind of been picturing Adam Smith sitting next to Zeus on a cloud up there somewhere, and Adam Smith saying, "There's this guy in a blue shirt down the Berkshires throwing your thunderbolts down that hill." Anyway, Lisa, can you tell us about your work with the Silicon Valley Social Venture Fund, and how do you see your role in the emerging new capitalism, impact economy, or whatever one wants to choose to call it?
Sure, and thanks, Laurie. And also thank you to the panelists who have all done just really amazing work, and I've been able to benefit from it. But I will use the acronym SV2, which is much shorter than saying the whole thing. I started down the impact investing journey about 6 years ago. Actually, when I first joined SV2, I initially joined so SV2 is a community of people. We pool capital. There's a long history of learning to be strategic donors to nonprofit organizations. But at the time that I joined, SV2 was just beginning the experiential learning of getting into impact investing. And that really resonated for me. I come from a tech and business background. And having to look for models which are sustainable and can actually meet the needs of what investors are looking for, it just puts another level there to achieve impact and actually to be able to sustain it and potentially not depend on donations. So I thought it was a very intriguing area to get into, became very heavily involved in it. So it's a great on-ramp for people who want to learn about impact investing and actually practice it. In terms of your broader question, in terms of the role, I think the purpose is that everyone needs to think about what role they can play in this. I am perhaps a little less convinced that it's as inevitable as Sir Ronald Cohen said. I think it is absolutely as necessary as he said. You know, one of the things that made me think about it, this will not be nearly as eloquent as the stories of Laurie or John. But it made me think about remodeling a home a bit. Because when you manage a remodel and you don't necessarily know the specifics of a contractor, one of the tricks that I learned is bring in the next subcontractor to take a look at the work that's preceding them. So bring in the painter to check out the drywall work while it's going on, bring in the drywaller to check out the framing work. And I think that what's happening now is young adults, they're checking out our work and they're saying, wait a minute, you didn't do this right. And they're really questioning capitalism in an entirely different way than has been done. And so they're saying, is capitalism going to work? And is it going to work in a way where many people benefit instead of only a few? Or is it going to be an engine for unbelievable inequality. They're basically saying, is capitalism going to work in a way where we are going to reverse and correct harms that have built up over time? And so my view is that impact investing, socially responsible investing, all that is a critical part of trying to change the way that capitalism operates and make it work for many, many more people. Otherwise, it's truly, I believe, at risk. So the role for any individual is to figure out what you can do to try to move in that direction.
Thank you, Lisa. Before we get to Anne, I want to ask John a question just to help clarify some terms for our audience, if you can, John. Socially responsible investing, or SRI, also described by some as negative screening, has been around for quite a long time, while ESG, as we've mentioned, environmental social governance, and impact investing have emerged in the last 10 or 15 years. Some people make the mistake of lumping the three together when in fact they are related, but quite different. And so I'm wondering if you can help us understand the differences by comparing and contrasting impact investing, SRI, and ESG.
Yeah, sure. And I'll keep it brief since I've already had some airtime here. So I think some people, you just blend those terms, like you said, a little bit, and there certainly can be some overlap. I think they have squishy edges, but in general, starting with SRI, the socially responsible investing, that is really the kind of high level screening, where the whole idea there is, as an investor in the public markets, I will not be investing in this kind of company. So that might be tobacco or alcohol, for example. ESG is focused on corporations, and that's really a more in-depth metric looking across environmental, social, and governance. And it's supposed to be a set of metrics that you can put on top of traditional kind of financial metrics. And the goal still there is the idea is that if you can really look at the ESG metrics and the financial metrics combined, you should still get a superior return with your ESG investments. So impact investing goes further than ESG in two ways. So it's not just focusing on avoiding the negative impact, which is kind of also what SRI is looking at, excluding certain things, but really trying to make a positive impact in a very specific field of concern. So whatever your impact category is. And then secondly, it also insists on measuring the impact that it creates through the ultimate sort of success of that company. And it tends to be smaller companies. That's why impact investing tends to be a VC kind of a thing, more of a private equity markets type of lever. So.
And as a longtime leader, indeed legendary leader in venture capital, I'd be really interested in hearing your perspective on impact investing. When did you first become aware of it? How do other VCs that you know, especially in Silicon Valley, view impact investing and its increasing prominence? And have you sensed that perspectives about impact investing may have changed over time among this community?
Well, Laurie, thanks for having me on the panel, and kudos to all the impact investors that I'm joining. My firm, Homeowner Venture Partners, is a traditional venture capital firm. We do the same thing we said we were going to do 30 years ago, which is invest in early stage enterprise software companies, meaning we're A-round and sometimes seed investors. Just a quick look back. When I came to Silicon Valley in the late 80s, it really was the 20th century. And today it's the 21st century. I mean, in the 20th century, which lasted until 2000, really access to capital was scarce. There wasn't very much capital around. It was hard to get. And the companies that got the capital were companies that had foundries and plants and access to hard resources. That's why it's called Silicon Valley. It's not called Digital Transformation Valley or Software Valley. That has really changed. Today, business value really is not those plants. It's not the access to capital. It really is just people. And that change of balance has really changed everything. Lisa referred to what people want to do when joining a company. If intellectual capital is your core asset, that means that companies have to attract the best and brightest talent And it means that talent has choice. And that talent is choosing companies that have not just fun products to build, but have the greatest impact to society and to the world at large. That is really the fundamental change that's going on here, is a change in business value. You referred to some of the classic scholars. And in Friedman's era, 80% of the value of companies was in tangible assets. Today, more than 80% is in intangible assets, people, data, intellectual property. So that's been a big change. And it does mean that even if a company is not directly doing climate change or clear products that drive social impact, they better have a mission statement that determines how they deliver that product globally. Do they have a culture that supports diversity? Do they have a strategy that supports multiple pricing strategies for different demographics? Do they support the people that work in the company, supporting other nonprofit initiatives? It really is a different platform that companies are being built on today.
Thank you. You raised a lot of very interesting issues that are not always or not common in the impact investing discussion. So thank you very much. Let's see, Andrew, let's talk metrics a little bit. Impact measurement has always been a key element in impact investing and impact enterprise. More recently, through the work of the Global Impact Investing Network, the IMP, SVT Group, and others, impact management has taken prominence. And even more recently, in the last year, Tideline has launched something called Blue Mark, which is an impact verification system for impact investors. Principal among the concerns is something called, and it's already been mentioned, impact washing, similar to greenwashing, which is probably familiar to most in this audience. Andrew, can you tell us about the role of metrics of measuring and managing for impact, and also of verifying impact for both businesses and also for investors?
Well, I think it's been through an evolution over the last several years. I mean, one of the things that Ronnie talked about early in your interview was the need for more transparency and reporting, and the idea of impact weighted accounts. Really, the idea that we need to integrate impact reporting into financial reporting, so that it's not like a separate thing, but it's actually like part of the financial reports of a business. And I agree that I think that's really important. But I also think that transparency is just like a place to start. Like, transparency in and of itself doesn't create any impact, and it doesn't ensure that companies behave differently. It's then a question of like what gets done with that data. And I think that's one of the reasons that people have increasingly talked about impact management as opposed to impact measurement. The companies that get certified as B Corps have to measure and manage their impact on all of their stakeholders. And they've got to do it every 3 years in order to get recertified. And when they do that, that data also gets verified by us. So there's a process so people know they can trust the data that they're seeing from those companies. And that's really important to the system. I mean, it gets to that point of greenwashing. One of the things that's been interesting to us is that that we made that system of measurement and management, we call it the B Impact Assessment, freely available since we're a nonprofit. We made it freely available online. And today there are over 100,000 companies that have used that impact assessment. So there's 4,000 certified B corporations, but there are 100,000 companies that are measuring and managing their impact. And built into that impact assessment are all kinds of tools and best practices and case studies that can help companies get started and put them on a path that allow them to benchmark against their peers and set targets so that they can improve their impact. And that's been a really powerful tool for tens of thousands of companies. And that data then is a really important way of knowing whether any impact is actually happening or whether we're just getting like impact washing. Ronnie also mentioned the SDGs, the Sustainable Development Goals, and one of the things we did last year was to create an SDG action manager, which basically takes the same principles that are in our impact assessment and frames them around the 17 Sustainable Development Goals, so that companies can set targets and know how they're doing in improving on the way to trying to help the world meet the Sustainable Development Goals by 2030. And so that's been a really powerful tool as well. I think what's coming next that is really exciting is that that governments around the world and lots of institutional investors have gotten involved in this area and wanting to see higher quality impact data from companies that they invest in. And I think that will lead to, over the next several years, some more harmonization that makes it a little bit easier for companies to report on their and manage their impact. Because right now there's sort of like an alphabet soup of impact metrics, and it makes it hard for companies to figure out which ones to use, and then also for investors to figure out how to compare companies to each other. And so that sort of road towards harmonization is going to be really important, and there will be an important role, I think, for government to play in helping to drive some of that. Entities like the SEC and the IFRS will have to, I think, play a role in helping to drive some of that harmonization.
Thanks. Yeah, if we have time, I'd like to get back to the policy question a little later.
Yeah.
Elisa, I'd like to talk about impact funding from an entrepreneur's perspective. At Impact Entrepreneur, we have produced numerous programs of our webinar series focusing on the expanding number of funding vehicles and instruments available to social impact entrepreneurs. The subject of blended or integrated finance, for example, has become more central to the discussion, and using philanthropy alongside or in coordination with private capital to create a more sensitive and mission-aligned funding continuum for early stage enterprises. Can you share with us your thoughts about the opportunities as well as the challenges that exist for early stage impact companies, especially with regard to seeking out mission-aligned capital?
First, I'm thinking back to some comments that Anne made, and I'm thinking about how social entrepreneurs, and by social entrepreneurs, I mean entrepreneurs who intentionally are having a positive impact focus in what they're doing. Tend to operate from they have their businesses, but they're doing those businesses within the context of society, and of course our society is operating in the context of the environment, and they're very aware of the impacts of that, the interplay between those different elements of business, society, and environment. And so I think that that part of what impact investors tend to bring is a real understanding of that, and wanting to support them as they try to look at all of the impact, whether it's positive or negative, but trying to make it overall net positive. So so impact investors definitely play that role. We also tend to be patient for investors, and so our time horizons may not be as aggressive as others. So there are a lot of positives there. But to your question about blended finance, there are different organizations that are trying to use especially the capital stack and direct a capital stack of different forms of capital at an issue. And so we are certainly looking at that within organizations as well. So one example from SV2, it's a very minor example, but a nonprofit that we made a grant to, we then later funded a development impact bond for the same organization. I think we're going to see more of that to try to drive outcomes using whatever the financial tools are that are appropriate. Philanthropy, government money, I was really struck by the work that John is doing with public funding, can really play a significant role for in areas of just funding areas that investors don't find investable. And that could include doing things like first loss guarantees, doing grants, doing other ways to de-risk impact investments for other investors, and being willing to take that role on. So there is, I think it's a little bit difficult right now for social entrepreneurs to actually figure out how do you pull those pieces together. I think that that's one of the big opportunities right now in the field. I'm not sure if I answered all of your questions, so tell me if I did.
I just a week or two ago did a webinar with Ani Patton Power, who just came out with a new book called Adventure Finance, which is a wonderful overview of all the experimentation that's going on around instruments and vehicles and integrated strategies. So that's one new resource that I'd heartily recommend to people to look up. Adventure Finance is the title. John, let's discuss financial returns that impact investors are seeing. There's been much discussion about how impact investments measure up to the market and whether there can be and should be concessionary allowances made if the social or environmental impact is significant. There are some impact investors who believe that they need to make market meeting or beating returns and that there is nothing concessionary about what they do. And there is a spectrum of others who take an arguably more nuanced perspective. And I'm just, where do you stand on the question of impact investing returns, and how much can you say about those returns in your sector?
Yeah, it's a great question, and I think there's room for both. And speaking quickly on behalf of climate tech, I think in climate tech, it's going to be really important to show venture returns from impact investing firms in climate tech, mostly because you look back 10, 15 years, there was the whole sort of initial clean tech, back when it was clean tech, bubble bursting, and a lot of VCs lost a bunch of money, and it kind of put a sour taste in folks' mouth for about a decade. So I think this time around, it's going to be really important to show venture returns. But that being said, there has been some innovation on the foundation and nonprofit side, where we're starting to see foundation and nonprofit vehicles actually making investments and being willing to take more risks or even allow for more losses over the near and long term. So a Clean Energy Trust in Chicago comes up as an example. Those folks are doing a lot of great work as a nonprofit, making investments in startups. So I think we're starting to find a way to include avenues for both of those approaches. But I think for actual impact VC firms in climate, we have to be able to show a return. Otherwise, we could see the same thing happen again, and that would be a disaster. And I'll just add on top of that, I've been talking about the climate tech side of it. I'm less familiar with some of the concerns or expectations in some of the other ESG categories, but I suspect in both of those there's room for growth. And anytime you're bringing in private capital, you want to be able to get as much of that into your industry as possible. And one great way to do that is by showing some kind of return.
Thank you. And were Milton Friedman's and Adam Smith's perspectives on capitalism in the market, Friedman's shareholder primacy and Smith's enlightened self-interest, were they wrong-headed, or are they simply in need of updating? And is the need for change evolutionary, or are we talking about a revolution here?
Well, I think you've already covered Adam Smith thoroughly. So Milton Friedman is also moving into the past for the reasons that I stated. I do think, when we look back, it'll feel evolutionary, but it feels very revolutionary right now, because some of the impacts that we need to really address are so important. And there's a couple things that are really going on here related to investment, listening to the dialogue. One is that we look for entrepreneurs that view complexity and uncertainty as opportunity. And if you look at the amount of capital that's been invested every year, the numbers get bigger and bigger. But if you look at the number of companies that get their first round of investment, that number has been shrinking, the number of companies every year for the last 10 years. So there's less and less high risk capital around. When we funded software companies beginning in '89, we pitched to 130 potential limited partners to form the first venture capital firm focused solely on software. And they said it was the stupidest idea they'd ever heard because the assets walked out the door at night. So we do have a real opportunity here for true venture capitalists to emerge, those that are really focused on taking risks, those that will solve big problems in big markets. John mentioned connecting all these national labs. One of our first investments was a company called Wind River Systems, guys out of Lawrence, Livermore, and their operating system landed the first Mars Land Rover. But it seems strange that we have to separate impact capital from non-impact capital. I think John and Lisa are really trying to merge this being just capital for true entrepreneurs who understand complexity and uncertainty is abundant right now. It's not in short supply. And the entrepreneurs are willing to take on these challenges. So we are having to knit together deals in the early stage, even for software companies, because people want to fund growth. They want to fund certainty. So that is one of the challenges we have at this moment in time, and it's really, really interesting to see that we have a digital transformation era here as being described as if it happened today. I think people will look at Tesla as sort of a miracle company when they see how hard it is for automakers to create real electric cars, manage charging stations, manage software updates, etc. So, we really are addressing some of the most interesting problems in this umbrella of social impact, just like we thought some of the most interesting problems were software 32 years ago. We now have data and cloud and all this other great stuff that allows capital efficiency to come to many of these big problems. But I do think it is really disruptive. And, Milton Friedman is now yesterday's news. Adam Smith is way yesterday's news. And it's Lisa, Andrew, John, and Sharani that are really today's news.
Thank you. Andrew, how about let's get back to policy and talk, if you will, about the role of government in our economic system. Do we need public policy, or can the market alone address the problems we seek to solve?
I think it's a pretty important question. For a long time, I would have told you in the early years of BLab that what we were trying to do was create an opportunity for entrepreneurs to opt into to be B Corps and to use business in a different way to solve big social and environmental problems, and that everybody else would just follow. Like in a free market, people would sort of realize this is a huge opportunity to run businesses in a different way, or to see markets that are untapped. And the result of that would be a system that solves some of the big problems that face us, whether they're environmental or whether they're about low wage work or the degradation of community. And 15 years later, I think one of the things that we've realized is that we have this isn't like, you can't just expect some heroic entrepreneurs to change a whole economic system. They can set an example, they can inspire all of the rest of us to try to follow. But if we have a system that's got a different set of rules of the game and a different set of norms, like if the culture hasn't changed at all, then it's pretty hard to change the overall system. Like John talked about the expectation of venture returns, and if we try to run businesses that are maybe solving some problems with their products, but have to be run to satisfy the same kind of voracious return expectations that then drive workers towards ever lower wages, or into markets where there aren't any protections for workers, as an example, then I'm not sure that we will really change the system. And I think that's the place where government starts to play a role. Like we still, as much as all of these things are big opportunities in the market, we still have a set of rules of fiduciary duty, both for corporations and for investment fiduciaries, like the people who run venture funds or private equity funds or big funds in the market, that say that their job is to maximize financial return for their beneficiaries, for the people who invest in their funds. And as long as that's true, I think it's pretty hard to expect a different system. And so one of the conclusions we've come to is that we need a different set of rules. That's what government's job is to set the rules of the game and to try to do it in a smart enough way that it doesn't hold us back, but that actually creates a level playing field. And so one of the things that we've proposed to the Biden administration, and that's being proposed in a number of other countries around the world, is a new set of fiduciary laws that would require directors of corporations, but also investment fiduciaries, to consider the impact of their decisions, not just on shareholders or not just on financial returns, but also on the social and environmental systems that are affected by their businesses or by their investment decisions. And I think that's a really important role for government, to set those rules of the game. Thank you.
So we have a few minutes left before we start taking some audience questions. And so I'd like to have a last question that I'd like each of you to answer. And that question is, where do you want to see change in the finance and entrepreneurship space happen most over the next 10 years? Lisa, would you like to go first?
There are a lot of items I could choose from. I would say that, first of all, I think there have been so many people who've been underrepresented in this space that it's critical to increase diversity of people who are involved in making all of these decisions and implementing decisions, because even when, say, fiduciary duty is changed, the implementation of it matters, and we need a greater and broader variety of people who are involved in all of that. And I'm going to kind of cheat here and add something else here that's somewhat related, which is around looking at how we allocate returns. Do we have the right allocation going? Right now, we've got the lion's share going to those who bring capital, and is that really the right thing? So I'll throw those out there.
How about John? Would you like to go next?
Yeah, sure. And thank you, Lisa. I had the same idea for my first one. I would love to see a way to make this industry more inclusive. And I think a big part of that, besides that's the right thing to do, is I really wanted to be confident that we are bringing in the most great ideas from everywhere, wherever they come in. And I feel like right now that doesn't happen all the time. So just being generally inclusive for people from all backgrounds, but also ideas, and who knows where the next big thing is going to come from. And I want to make sure that when someone has an idea, that someone's there to fund it and get it out in the world.
Anne, can you go next?
Yeah, one of the things that pandemic has done, hopefully, is caused venture capitalists to look further. In many ways, venture capitalists are lazy in that many of them say, we'll go fund a company within driving distance. Well, no one drives anymore, so distance has gone away. But I didn't go to Stanford or Harvard or MIT. I went to the University of St. Thomas and the University of St. Catharines in St. Paul, Minnesota. So I don't have the typical pedigree of a venture capitalist or of an entrepreneur, both of which I have been. So I do think that perhaps with the pandemic, we will look further for entrepreneurs and distance goes away. And that further includes not just in the people, but in ideas. I think that our willingness to audition more companies, our job is to audition the future as early stage venture capitalists. So in many ways, we're writing checks for the future, which we'd really like to see a better future than the one John described, the world on fire. So my wish is that people will look further for people and for ideas.
I'll pile on a bit. I mean, I think that, very little venture funding goes to women entrepreneurs and to entrepreneurs of color. The pandemic and I think in particular, George Floyd and the aftermath have caused a little bit of a shift there, with a lot of people, I think, wanting to try to drive more capital, particularly to entrepreneurs of color. And at the same time, a lot of the systems don't exist in order to actually to ensure that happens. And so there's lots of infrastructure, I think, that's needed to support that if we really want to have an inclusive economy that has entrepreneurs from all over that are creating great businesses that are good for the world. So like that would be a big hope to me. But the second one would be in particular that the entrepreneurs who are starting businesses today, particularly young ones, are not beholden to the systems that have existed for a long time. They're here to break a lot of rules. And I think there's an opportunity for them to inject into the DNA of their businesses a totally different way of thinking about the purpose of business and the impact that they're going to have in the world as they build those businesses into future public companies that are the businesses of the future. And so my hope is that they'll be conscientious and intentional about that as they're building their businesses, not just that those businesses are disruptive with new products, but that they're disruptive with how they think about all of the stakeholders that are affected by their business.
Thank you. Thank you all for answering that question. Let's look now at some of the questions from the audience. Looks like Andrew is asking, why should the private sector and investors be responsible for solving these impact issues instead of governments?
Yeah, big question. Yeah, I think that there's a clear point where government is less effective. Government is great at early stage R&D and supporting industries and tweaking policies to facilitate markets, but private industry clearly sings when it has the rules in place and a path to market to make things scale. So, I think if you want to get solutions to scale, global scale, you need private industry to get it there.
Okay, here's a question for the whole panel. How would you contrast ESG funds with what's happening with engine number one's new vote EFT? Is one better than the other? Andrew.
I'm happy to take a shot at that. One of the things that for a long time, the way people thought about like the evolution of first what was called socially responsible investing and now ESG investing has mostly been about either avoiding bad things or trying to invest in companies that either do a good job of reporting on their impact or have a particular area of impact that they're focused on. And I think more recent has been really trying to engage with companies, not so much avoid bad companies, but actually engage with them and try to get them to improve. Trying to take some of the tools of like activist hedge funds and apply them for social and environmental impact. And so the person who asked that question is referring to a new hedge fund called Engine Number One that just was successful in driving a big change in the board at Exxon by using kind of activist, sort of traditional hedge fund activist approach, but in order to replace people on the board with people who had more of a climate focus. And I think I think that idea of engagement is one of the best ways to get companies to change their behavior. Not everyone believes that that's the right approach, but these companies exist, and if we can engage with them actively and get them to change their behavior, that's quite powerful. It also gets to one of the things that they've done is created an ETF that answers a question that I think you asked Ronnie earlier, which was whether there are retail products that people can invest in, and so. There are lots of things, lots of ESG funds that we can all invest in our 401k plans. But this is one of the first ones that this person is asking about that allows people to invest in an ETF that then they know that the managers of that ETF are going to be actively engaged in trying to push those companies that they're invested in to change their behavior. And so it's a lever. That I think is quite powerful.
Just wondering if any of the other panelists have perspective on the the engine number one initiative and its success?
I'll just mention actually another alternative, which is an investment that SV2 did in a company called OpenInvest. And that's another one that's targeted at retail investors. It was just announced today that they are being acquired by JP Morgan. And it allows individuals to both screen out the negatives, but also screen in positives along themes that they care about. So, one of the screens they've been recognized for is divesting of the prison industrial complex. But it's both sides of it, and so you can really customize it for what your values are. So it's completely different than what the hedge fund is doing, but not entirely. In that it's also an attempt to get to the point to aggregate shareholder power to engage in shareholder activism like that. So there are a number of initiatives in fintech that are along the lines of moving toward greater shareholder activism and for everyone to be able to do it.
Impact metrics seem like they can be burdensome for startups. What options do they have to quantify impact and still stay focused on mission?
One of the things we do is that startups can get what we call pending BCorp certification. So essentially what they do is they put in place the change in fiduciary duties, and they use our impact assessment as a roadmap, but we're not doing verification of the data yet. And so they've got some time to get up and running, figure out what are the things that actually matter to them. It helps maybe create some things that they want to target for social and environmental impact without being burdened by an incredible amount of reporting or verification. And I would say in general for startups, like no question, the most important thing is to figure out like what's important to you, not so much to be doing a ton of burdensome reporting.
John, it's interesting that Momentum and MXV have been able to help startups raise public funding for early stage ventures, since usually private venture capital is the usual tool to raise capital for risky ventures. Could you elaborate on what kinds of public funds were raised or are available? Any advice for climate entrepreneurs out there for best practices to access these kinds of public funding sources?
So, I mean, I would say the opposite is true. I think most venture capital, even at seed stage, is post R&D, right? So, I mean, I think for one thing, you see a ton of government funded R&D. So if you're in hard tech or parts of climate tech that require research, even I'd say on like some of the software side of things too, getting government support for those projects is pretty critical. A few programs look at the ARPA-E, that's the Advanced Research Projects Agency for Energy. It's like DARPA. Check them out. SBIR, the Small Business Innovation Research Grants. Look at the Department of Energy, grants.gov has a whole bunch of solicitations that come out all the time. If you're in California, the California Energy Commission, NYSERDA in New York, that's NYSERDA. Massachusetts does a bunch of stuff as well. So I'd say start mining the state and federal and even local government sites, the energy sites and sort of research divisions to get a sense for what's out there. Really the role of government R&D is to get through those sort of valleys of death, they call them, right? There's the initial research, get the idea together, your initial seed funding, but then after your seed funding, there's still a gap before you can get to like a Series A or something, where oftentimes you have a cash crunch, you need to do pilots and demonstrations, and those are great sort of avenues for public funding to make an impact.
Here's a nice spicy question. It seems society already created a cure for the Adam Smith virus. It's called Marxism. Wouldn't you agree? Well, I'm personally, since I invoked Adam Smith at the beginning, I will say that I am interested primarily in assessing and reforming the capitalist system. I do not have a comment and not terribly well educated on the Marxist alternatives. However, if you're based in Silicon Valley and you just head up the pike and go over a bridge or two, you get to Berkeley, you'll find plenty of authorities on that subject matter there. Anybody else want to address this point? No? Okay. As Ann said, this may be really old history, so we don't need to go down it anymore. Thank you for the question, though. Always happy to see B Corp logos on products. What B Corp certified business would be the most surprising story for the audience? I guess that's to you, Andrew.
You know, there's 4,000 great stories in the B Corp community, and so it's hard. It's always hard to pick one. You know, one of the most exciting things to me is that where a few years ago, you know, it was mostly us begging companies to put that B Corp logo on their products or on their websites or in their marketing materials, because the brand didn't have any value. Today, that's the other way around. And the companies push us to try to market the brand because it's come to have a lot of value and mean something. And it's come to mean something, I think, for consumers, but also really importantly for their own workers and for their investors, to the point of all the conversations we're having today about the capital markets. So I think it's become something that's got a lot of value. And, you know, companies go through different kinds of journeys when they start down the certification path. And so, you know, there are obviously like the obvious stories like the Patagonias of the world that are companies that are already doing phenomenal work. And the reason they become B Corps is to help to codify it and to make it clear to all of their stakeholders and have a third party verifying it. And also to be able to, because they realize that there's more power in being part of a movement than there is just in their own brand. But there are lots of other companies that you wouldn't expect that start down this path because sometimes because their own employees demand it of a CEO or of the C-suite and say, like, we want to work for a company that reflects our values. And that leads to some pretty dramatic changes. There was a company recently that was telling us that as a result of going through a B impact assessment, they realized that they didn't pay most of their workers a living wage. And the CEO decided the next day that there shouldn't be a single employee in that company that wasn't paid like a family sustaining wage. And there are a lot of inspiring stories like that.
And what are some of the best ways to support entrepreneurs with good ideas but haven't quite gotten off the ground?
Well, almost all entrepreneurs are at some point a person or persons with good ideas that are trying to get off the ground. And I think the commonality here is it's hard to build companies from scratch. Entrepreneurs have to really look for, first of all, investors, either individuals or venture capital firms that truly believe in them. Lisa mentioned patience. And that's not just for social and impact companies, that's for any company. Today, a typical company is not even acquired until typically year 6 or 7. OpenInvest, congratulations on that. What a great outcome. But it's a long journey. And I do think also looking for the right kind of mentors along the way that are not the kind of mentors that make you feel good all the time, but give you honest, critical feedback, and you accept that feedback. That's the best way to get off the ground. The other best way to get off the ground is doing what John suggests with is teaming up with excellence. One of the chief characteristics we look for in any company we fund beyond a large market opportunity is the ability of the founding team to attract that excellence. And that's something you have to do at day one. Is find challengers, find teammates, connect yourself onto the market map early while you're devising that product so that the lift is faster for you to get off the ground. And that really means, the old-fashioned networking, a lot of it with your colleagues that you've gone to school with or that you are working with. But you have to do the things that John showed in his slides, is connect back to where things are really, really happening and there are real challengers to your ideas. Also, you may need help just building a business model around your idea or product idea. That sometimes is really the hardest area where entrepreneurs don't get lift off. They're pitching us products. We fund businesses, not products. And that still seems confusing to a lot of first-time entrepreneurs.
Thank you. Lisa, I'm wondering, do you have anything you to my add? Ann gave a pretty comprehensive answer, but from your experience, do you have more, any more good ideas about how to help entrepreneurs get something off the ground?
Entrepreneurs that are oriented toward social and environmental good, the just being able to articulate that well and have a very clear logic between the outcomes that you're trying to drive and how whatever you're doing is going to drive those outcomes. It's a very important piece, at least for those investors who focus a lot on the impact of the investment.
Okay. Next question is, do any of the panelists specifically not work with benefit corporations? Is there a downside to incorporating with a non-traditional structure like CRS Corps?
I personally like benefit corporations. I mentioned OpenInvest a minute ago. They are a benefit corporation. So I'll just throw that out there.
Ann, have you seen benefit corporations come in the door?
Yeah, I guess I have a question for Lisa. Given that it's JP Morgan who's buying OpenInvest, correct? Whether was there any friction in the acquisition process because of them being a benefit corp? Because I think that's really the important question here. Is, we're not seeking benefit corp. So if someone came to us and said, "I'm ready to roll," but I need 8 more months to go through some of the certification process, we might consider that friction versus how do we articulate the same benefits and the mission and the quality of leadership in the company. So maybe Lisa can add more commentary to, was there any friction in the process to the ultimate outcome for this company because of how they'd incorporated?
And I would love to answer that question, but I was not privy to the process. And I suspect, though, that given what they are trying to do, being a benefit corporation is very much in line with what their overall mission is as a company. So I would be surprised if being a benefit corporation provided additional friction. But they made that decision, and everyone who invested in it early on knew it. So there was no friction in terms of them raising the money to get to this point.
Laurie, if I could just add 1 or 2 things to that. Just to be clear, like many companies, as I said, are structured as benefit corporations, or what in Delaware is called a public benefit corporation, which is what OpenInvest is. That doesn't mean that they have gone or need to go through a certification process with BLab, which is a private party that runs a certification process. So many companies have just put that legal structure in place in order to ensure that they're clear with both their stakeholders and their investors that they're going to consider these kinds of stakeholder interests or ESG interests as they're making decisions. And all it means is that, at the board level, that's a part of the process or the considerations that the board goes through when it makes decisions, including a decision to sell the company. We have lots of companies that have that structure that have been bought by other companies and maintained that structure like as a wholly owned subsidiary, for example. So there are some big corporates like Unilever or Danone that own multiple benefit corporations, like companies that have got that legal structure in place, and they've maintained it as wholly owned subsidiaries. And then, as I said, lots of startups that have gone through the process and ended up going through like an IPO, like Coursera, just had their IPO with that benefit corp legal structure in place. They're also a certified B corporation, and they had no friction as they were going through that process in the public markets. So I think 5 or 6 years ago, when this was a relatively new corporate form that not a lot of people knew about, there was certainly friction, and law firms and investment banks and venture capital and private equity firms had to be educated. But at this point, most of that friction has gone away, and that's allowed all those companies to sort of go through the investment life cycle as they go from early stage funding all the way through IPOs.
I recall several conversations with people who followed the Ben & Jerry's Unilever acquisition who, have said pretty much the same thing, that early on when that happened, there was a tremendous amount of worry by the founders as well as others that Ben & Jerry's might lose its mission or sense of mission. I think that there's a perspective out there that actually the bigger change was to Unilever, and that the social and environmental values of Ben & Jerry's had a very, very significant impact on their new parent company. I don't know if any of you want to comment on that.
Not on Ben & Jerry's, though. It sounds delicious. I could go for some right now. But just a quick follow-up for Andrew on the kind of opposite end of that. Do you see benefit corporations ever being treated almost as nonprofits by, say, funding agencies? Again, coming back to kind of the public funding angle here, a lot of agencies, a lot of solicitations are only for nonprofits. I'm hoping that at some point we'll see those merge.
Yeah, there have been a number of proposals, both in a number of states and by the federal government, that they use that legal structure as a designation for to be qualified for like government investment. And basically the idea is like, if you're gonna get capital from the American people, then you ought to have built into your duties a duty to benefit society, not just the shareholders of the company. And so there are a number of proposals floating around out there to make that a requirement, whether it's for government procurement or funding from the various like ARPA type funds in different departments of the federal government. And I think those are really interesting ideas to ensure that where you have for-profit businesses that are going to benefit from government money, that they need to be beholden to society, not just to the shareholders.
Yeah, that's good to know. And I may follow up to see if I can get some more information on that, because that's
yeah.
Thank you.
Andrew,
Yeah,
is there a listing someplace? You mentioned Coursera, for example, and we just talked about OpenInvest, where entrepreneurs can find a listing of contemporary benefit corps, so they have an opportunity to reach out to those contemporary CEOs to talk about these issues directly?
Yeah, if you go to bcorporation.net, I will try to follow up with a link that maybe the sponsors of the conference can distribute. But on bcorporation.net, you can find companies you can find certified B Corps, and you can also find a link to companies that have just got that legal structure in place.
Thank you all. I think we are not only at time, a little past time. Thank you, Jack, for being patient with me and the panel here. But I deeply appreciate it. It was a great honor to moderate this discussion. And Lisa, John, Ann, and Andrew, thank you so much for the generosity of your time and for participating. Jack, I'm going to pass it over or back to you.
Thanks, Laurie. Thanks to all of you. We appreciate so much you being here tonight. And I hate to break this up because it's a terrific conversation that can probably go on for another hour. We see this as being the first in a series of events that we'll be producing both in person and online around B Corp movement and impact investing movement. And now, thank you for coming. And now go out and create positive impact in the world. Good night.